Imagine driving through a modern city filled with skyscrapers, highways, shopping malls, and apartment towers, and barely seeing anyone. Why would anyone build a city before the people arrived? Over the last decade, international media outlets frequently circulated images of these vast, quiet districts, tagging them with a catchy label, ghost cities. But that term is a Western invention. You won't find it in any official economic or demographic category. A traditional ghost town is a place that has been abandoned, a Rust Belt collapse where industry dried up and the population fled. What we see in China is something else: newly built satellite districts experiencing expected low occupancy during their initial rollout phase. The global fascination was heavily fueled by bizarre architectural choices found in these early developments. When journalists saw replicas of Parisian landmarks surrounded by quiet streets, it created a compelling narrative of failure that was difficult to ignore. These quiet streets represent aggressive, highly calculated bets on future residents. This chart compares China's rural and urban populations since 1978. While the rural line is flat, the urban curve climbs aggressively towards 64%. This represents hundreds of millions of people leaving the countryside. To accommodate the largest human migration ever recorded, local governments built completely new urban districts from scratch. Executing a national urbanization mandate of this size required staggering physical labor and an unrelenting pace of construction. Housing millions of new arrivals year after year meant turning raw earth into concrete grids at a speed never before attempted. To survive this demographic wave, China could not afford to build cities reactively. Waiting for housing demand to peak would have triggered massive overcrowding. They had to pour the concrete, lay the fiber optics, and build the infrastructure proactively. The motivation to build quickly is deeply embedded in the political structure. Chinese municipal officials operate in a system described as local GDPism, where career advancement is tied to generating immediate economic growth and delivering massive infrastructure projects. At the same time, structural changes in the 1990s centralized tax revenue to the national government. Local municipalities were left with immense spending obligations for public services, but limited avenues for traditional income. To bridge that gap, cities turned to the land finance mechanism. The state owns the land. Municipalities acquire vast rural tracts, zone it for development, and lease rights for massive sums. To bypass strict borrowing limits, municipalities use a local government financing vehicle to issue urban investment bonds, converting investor capital into physical infrastructure. Between 2013 and 2022, this debt market grew 21% annually, reaching 13.78 trillion yuan, the country's third largest bond category. Local governments build these districts because executing land development and securing bond financing is the primary engine funding their municipal operations. You can see exactly how this plays out in Kangbashi, a district in the city of Ordos. In the mid-2000s, local coal output exploded, generating tens of billions of yuan in revenue. The government channeled that resource wealth into a project designed to house 1 million residents. During its first 5 years, journalists flocked to Kangbashi. What they found was a city with a fraction of its intended population. Commercial vacancy exceeded 70%, and central heating plants ran far below capacity. The government poured funds into oversized public infrastructure. It was a move to anchor the new city center and project confidence to future buyers, even while the plazas remained empty. Foreign reporting captured a snapshot of a city that had supposedly failed. But urban planning researchers note that Kangbashi was operating on a 20-year development timeline. Low occupancy in year 5 was written into the blueprint. The local government eventually relocated vital government offices and Ordo's #1 high school, the region's top educational institution, to the new district. Families followed the school, and property purchases surged. The viral images simply caught the awkward, highly exposed adolescence of a multi-decade urban master plan. The vulnerability of this model lies in its momentum. If urbanization slows and housing demand cools, local governments are still left holding trillions in bond debt. That momentum hit a wall in late 2021. The real estate giant Evergrande officially defaulted on its debt obligations, a moment that shattered the illusion of endless property demand. This academic paper outlines the mechanics of the fallout. When a super large real estate company defaults, it immediately spikes the risk premiums on the urban investment bonds issued by local governments. The risk spills directly from the private sector into municipal debt. The financial panic was swift. Wealth evaporated across major stock market indices, and confidence in the borrow first to acquire land business model collapsed. Land transaction volumes plummeted. The physical consequence is the appearance of rotten tail buildings. As capital chains snap, developers abandon projects, leaving buyers with mortgages on unfinished concrete frames. The build-it-first model acts as a massive economic amplifier. It creates physical growth during a boom, but when the cycle turns, it triggers cascading fiscal crises. Despite the current debt crisis, history offers a heavy counterweight. In the early 1990s, the Pudong district in Shanghai was mocked as empty farmland. Today, it is one of the premier global financial districts on Earth. The Zhengdong New Area was once a central fixture of ghost city reporting. Today, its economy has expanded rapidly, and the district is a thriving commercial hub housing 1.3 million people. The system creates a dangerous speculation bubble, while simultaneously constructing high-density housing for hundreds of millions of people in a single generation. China's so-called ghost cities show what happens when investment and construction outpace population growth. It leaves us with a central question: are these failures, or cities that simply arrived before their residents?